Members of the management, please proceed.
Good evening, everyone, and thank you for joining us on our Q3 and 9-month FY22 earnings call to discuss the operating and financial performance for the quarter. I hope you all had the opportunity to go through our results presentation, which provides details of our operational and financial performance. We have delivered a steady performance on a year-on-year basis during the quarter despite a challenging inflationary macro environment. Our HPPC business continues to record healthy performance driven by stable offtake from the FMCG segment. This, in addition to traction in our antiviral and hygiene portfolio segment, supported volumes in HPPC division. In our TSC and EHN businesses, we saw an encouraging pickup in demand. Further, steady growth in the export market aided sales in the TSC division. We expect this momentum to strengthen in the quarters ahead. On a standalone level, we registered an organic top-line growth of 31% year-on-year in Q3. We are pleased to share that this is the first full quarter of consolidation of our recent acquisitions of Unitop and Tristar in Rossari's performance. Both these companies delivered growth during the period, which assisted our overall performance. The integration is in sync with our internal schedule, and the further synergies from these acquisitions will be visible over the next fiscal. On the profitability front, the raw material situation continues to remain challenging. This impacted our margins during the quarter. We believe these raw material pressures and inflationary trends may continue in the near term as well. In order to offset them, we have been working alongside our customers and have been undertaking suitable price hikes wherever possible. On the whole, we believe we have reported a stable performance in the current environment. As we look ahead, we will continue to focus towards growing wallet share across our existing customer base while tapping new customer segments. Our long-term endeavor is to consolidate our market position as a preferred supplier in the Indian industry. From a macro standpoint, we remain positive about the improving demand trends across our product offerings, and we look forward to a healthy performance ahead. With this, I would like to conclude my address, and I now hand it over to Chariji for his comments.
Thank you, Edward sir. Namaste and good evening to everyone. We have delivered an encouraging performance in the 9-month period supported by strong traction in our HPPC, textile specialty chemicals and EHN businesses. We are also witnessing improved traction in engagement with several new and existing customers across various industries, leading to a healthy volume in all business verticals. On the raw material front, as Edward indicated, we continue to face challenges. However, our team has been able to navigate through the situation well, and we have been able to seamlessly manage supplies to all our customers on time. As the raw material situation stabilizes over the course of the next fiscal, we are confident of reporting improved margins going forward. This is our first full quarter of consolidation of our recent acquisitions of Unitop and Tristar in Rossari's performance. The integration of these two companies has brought several promising growth prospects. We are actively undertaking strategic cross-selling opportunities and continue to strive towards expanding into newer market segments and customer categories. Additionally, our latest acquisition of Romack Chemicals has now been consolidated with effect from December 1, 2021. The timely integration of Romack will further strengthen our presence in the home and personal care segment going forward. The blend of capabilities from all these strategic acquisitions enable us to build our presence and gain scale in our key segments, thus accelerating growth for Rossari over the next few years. On the operational front, we are developing offerings that are custom-made, environmentally friendly and cost-neutral. As a company, we have always advocated towards sustainable processes and green chemistry from the very beginning. Rossari is one of the front runners in the domestic market for producing environmentally benign substitutes across segments. Our green products have been widely appreciated in the market, and we are constantly evaluating opportunities to introduce new business lines with distinguished and sustainable offerings. This will be another strong growth lever for us going forward. We are also happy to share that all our latest product launches across hygiene, laundry, and fabric care segments have seen improved acceptance amongst existing and new customers in the domestic market. The specialty chemicals industry in India is fast progressing with multiple strong growth prospects ahead. Rossari is well poised to capitalize on the significant growth opportunities given its diversified range of green and sustainable product offerings, fungible and agile manufacturing establishments, and the ability to constantly innovate and launch diversified products for its growing customer base. To conclude, we are witnessing a strong recovery in consumption patterns that should further support volumes going forward. On that note, I would now request Mansi ji to share perspectives on the financial performance for the quarter.
Thank you, Chari sir. Good evening, everyone. Let me provide you with a brief overview of the financial performance for the quarter. During the quarter, we have delivered a steady performance on a YOY basis, driven by improved demand and traction across businesses. On a consolidated basis, revenues came in at 428.4 crore against rupees 210 crore in Q3 FY21. On a standalone basis, we registered an exceptional organic revenue growth of 31% YOY in Q3 FY22 and 66% in 9 months FY22, owing to strong client wins. Revenue from HPPC stood at 305.2 crore, contributing to 71% of revenue, followed by TSC business at 102.8 crore, contributing 24%, and AHN at 20.4 crore, contributing 5% to total revenue. On the profitability front, EBITDA stood at 46.7 crore against 34 crore in Q3 FY21. EBITDA margin stood at 10.9% as against 16.2% in Q3 FY21. As indicated by Edward G, gross profit and margins during the quarter were impacted on account of raw material challenges. Depreciation was higher at 17.8 crore owing to amortization of fair valuation on account of consolidation of subsidiaries. Interest costs during the quarter stood at 3.5 crore. PAT during the quarter stood at 22.6 crore as against 21.6 crore in Q3 FY21. Overall, the company's financial position remains strong. This is even after concluding our strategic acquisitions and undertaking several growth initiatives. As we derive synergies from these acquisitions and with optimal utilization from our existing manufacturing capacity, we look forward to delivering strong and sustainable growth in the medium to long term. On that note, I come to the end of our opening remarks and would request the moderator to open the forum for any operational and strategic questions that you may have. Thank you.
Thank you very much, ma'am. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sanjay Jain from ICICI Securities. Please go ahead.
Good evening, all, and thanks for taking my question. I got a few questions. First, on the segmental, I wanted to understand any thought process beyond including the Unitop revenue in the HPP segment, because we understood during the acquisition call that it's predominantly an agrochemical and oil and gas segment where we derive revenue in the Unitop. Any particular reasons for including that in a home and personal care segment?
Sanjay ji, namaste. This is Sunil Chari. Unitop and Trastar both are in surfactants. As a category, surfactants we have classified under the HPPC segment. Anything which is not textile and animals and nutrition, we have classified in the home, personal care and performance chemicals. Agrochemical surfactants and surfactants for oil and gas and specialty products for additives for personal care will come under performance chemicals and home and personal care, and hence we have classified under HPPC.
I think now performance care has become quite big. It would be relatively easier for us if you can segregate that also. That would probably be easier for us to track. That's a small suggestion from my side. The second question is on the standalone revenue. Any reason why it has dipped by 700 million quarter on quarter, and it looks like predominantly has come from the erstwhile HPPC segment? Can you help us understand where is this decline coming in, and what has been the reason for such a steep decline on a quarter-on-quarter basis despite tariff hikes?
Sanjay, this is Ketan here. So in quarter two, what we had talked about was, there was a lot of pent-up demand and which flowed in from quarter one to some extent because of the COVID issues in the beginning of the year, and that's why the sales revenue for Q2 was significantly high. And we also indicated that going forward, probably we'll be able to, this figure is going to get a little more regularized on a quarter-and-quarter basis. So currently, the way we see the business on a quarter basis, we are targeting about around 270 odd crores of turnover per quarter. I think that's the run rate currently we are looking at. Probably we'll end the year also at this run rate, and maybe next year we'll see some jump on an annualized basis over the turnover. Maybe about 15 to 20% is something which we are targeting for next year, and on a standalone basis. So I think currently we can take 270 crores as a run rate on a quarter-to-quarter basis.
Sanjay, I would like to add here, our first quarter sales was around 204 crores, and the second quarter sales, which was abnormal, and we had announced that it was abnormal, it was 339 crores. So as Ketan sir added, we were at 540 crores in the first half. So 220 was our average, and we are at average. Because the second quarter was, pent-up demand, and, we got very good sales. I think we should not take away the good performance in this quarter too.
Sorry. So I was thinking that there was a steep increase in the raw material. We would have taken up even more price high across the category, because I was looking at the raw material prices across the 4 key raw material we use, and the inflation looks like there has been a inflation Q1 to Q2, Q2 to Q3, and now Q3 to Q4 also that inflation continues. On that back of that, so how to look at the volume growth? What has been the volume for us in the 9 months of FY22, and what is the utilization level for us in our new Dahej plant as we speak now?
So, Sanjay ji, as you know, at Dahej we have 132,500 tons capacity, and Silvassa we have 120,000 capacity. At Unitop we have 86,000 tons capacity. On an average, we are looking at about 60% capacity utilization across the company. And you see, what we need to, Sanjay, also I wanted to add here, we, in the 12 months now, we are expecting our Rossari sales to be 1075, and consolidated numbers at 1,500 crores. So if you see, last year we were at 700 crores, and now we are nearly double. So we are expecting double already in this year. We are told that we will do double in 4 years, and we are doing double in this year. The raw material volatility, Sanjay ji, has been abnormal. But even as of this month, it is like last month acrylic acid price was $2,000, and we were expecting it to come down, and then suddenly this month it has gone to 2,700 acrylic acid price. I'm talking about dollars, USD dollar, per ton. Now we were expecting it to go to 10-20% down, and it is at 2,700. So you can see a 50% up and down volatility in raw material price, which is unimaginable. And अभी हम लोग कैसे raw material procure करें और कैसे हम लोग उसके ऊपर बेस करें, because भाव गिरता है तो customer expect करता है कि हम लोग भाव गिराएं और हमारे पास higher price inventory आया. So what we saw and what we have seen is the volatility has continued like maddening, like within the last 6 months. We thought it will stabilize, but it looks like this volatility to continue in at least the next 2 quarters. It will be the same. What is happening is we have earned good amount of money as a company. Our sales have been robust, and we have ensured that the volume growth is high, but also customers we have catered. Our supply chain has been intact, and धंधा में अच्छा किया है. So we are happy with the performance which we have done till now.
No, fair enough. I'm not taking out anything, the effort you have put in doubling the revenue. But we also appreciate that there is a huge amount of revenue benefit coming up from the inflation, right? And there is no additional profit we can earn on the inflation. That was the point. But can you just help us with the number? What is the utilization level today at the Dahej?
Sir, it is in the range of 50 to 60% utilization levels across different sites, sir. So we also want to add here, Sanjay, we do not need any big capex in the next financial year. We have, I think to take up to 2,500 crores or more, we have adequate capex, so only maintenance capex would be required, which is there. And Dahej, we are, happy to, as we said in last year, Dahej will complete in the next 4 years all the capacity utilization.
Got it. 2 bookkeeping question, if you can help that, Ketan bhai. What is the revenue and EBITDA for Unitop and TriStar for this quarter? And I cannot see a minority interest number. We haven't acquired the 100% in Unitop and TriStar. Just wanted to understand why there is a nil minority interest in the consolidated level.
We are considering Unitop as a subsidiary because even if we have acquired 65% shares, it is 100% control. As per the agreement, 100% control is with us. That is why we have not accounted for minority interest.
Fair enough. And can you provide the revenue and EBITDA for the Unitop and TriStar?
The revenue for 3 months which we have consolidated is for Unitop it is 118 crores and for TriStar it is 43 crores.
And EBITDA?
And EBITDA is for Unitop around 16 crores and TriStar is 4 crores.
Sanjay ji, I want to add here, Unitop 9 months we have done 330 crores and TriStar 9 months 115 crores. This year we have already crossed the full last year sales, 12-month sales in this 9 months. So the performance in our subsidiaries has been heartening. It has been very, very good.
Fair enough, sir. Completely appreciate that. Last question from my side before I come back in the queue. I was just looking the performance of one of your listed peer, which is here, Finotech, and their performance in textile look like they are gaining market share, and we are not being growing equally to our competition in the textile chemical segment, and the margins also look pretty healthy. Any comparison or any thought you want to share on that?
Sir, our textile specialty chemical business has done quite well. So we are seeing, even if you compare to the last quarter, we did from 109, we have still, touched 102 crores. So 102 crores, if you multiply by 4, it is 400 crores, which is nearly, 50% higher than last year. So the textile specialty chemicals is, something which is doing very well, and we expect, good sales. Our exports have also picked up across the segment, across, the textile business, and we see, a good traction for the textile business in the coming years too.
No, I was looking at their numbers. They have grown faster than us. They were probably at 50-60% of the revenue what we were, and now they are doing the same revenue as Rossari. Last quarter revenue for them was 105 crores. So they are now hit the revenue of our 100. So that was the thought process I was trying to understand.
We would continue to focus on our numbers, Sanjay ji, and we are seeing a very, very good traction, with the new launches in softeners and pre-treatment, and now with the Unitop and TriStar, the surfactant category should increase. And I think Edward ji can add here to some of the products which are planned for the textile business. Edward ji.
Yeah. So Sanjay ji, like Mr. Chari has mentioned, that we have also lined up a lot of products for the textiles, and the synergies that will emanate from Unitop as well as TriStar because of the surfactants they manufacture have not yet been percolated down to Rossari. So that is yet to happen. If you look at the various products that we are introducing in this year, we have added 2 new green chemicals to our green chemical stable. One is green urea and the other is green silicate. So these 2 products we have introduced. We have also introduced a stable chlorine substitute as well as an enzymatic chlorine bleach. We have introduced lycra protectors, and we are doing a lot of work in the continuous bleaching range too, because now that Unitop will manufacture our own surfactants, we will become very competitive. Another very important point to note here is the acquisition of Romack. Now with the venture with Romack, we have already started manufacturing the silicone polymers for textile finish at Dahej. That is the block silicone, which is the technology which very few companies in the world have. So our offering in the marketplace is going to increase. Our share in the export market also has increased considerably. We've also introduced a new technology, that is polyester resins for sizing, as well as polyester polyols for the various anti-soiling, anti-static, and anti-backstaining products which are manufactured now at Dahej. So all these developments are going to take some time. The focus in the last quarter was not on sales, but was on basically trying to protect our margin and trying to have alternate raw materials and pressure on customers to build on pricing. Because what happened is in the last quarter the prices started stabilizing and started softening, and suddenly the prices started going up, and that created a little bit havoc, because of which our focus was mainly on supply chain as well as on the margin side.
Fair enough, sir. Thanks for providing that detail, and best of luck to the team for coming quarters.
Thank you, Sanjay.
Thank you. The next question is from the line of Ashish Upganglawar from InvestQ Investment Advisors. Please go ahead.
Yes, thank you for the opportunity. Gentlemen, wanted to understand, we have seen a huge movement in the margins since you have listed. I understand that this raw material issues across industries, it's been a troubling issue. But is it because of these intermittent management, raw material price and quotation to customers, this kind of a difference that would be there, because timing difference that is causing this, or there is certain element of no pricing power beyond the point to charge to the customer. So I'm trying to understand on an ongoing basis what would be your gross and EBITDA margins if I have to take a view of say 3 years on an average basis.
Ashish, see, the way the raw material prices are currently behaving is becoming a little difficult for us to the prices are going to be, so that we can go back to the customers. As Edwardji was already talking about that, this quarter we started the quarter thinking that prices are going to be, coming down, softening, stabilizing, and then again we saw the prices suddenly moving up. So for us to now critically analyze or get into some sort of a long-term contract or even a short-term contract, it's really a call we are taking on a daily basis as to how we deal with the raw material prices. In fact, the prices today and probably what the prices will be tomorrow is very difficult for us to guess. And so our current plan is that we are looking at a fairly short-term spot kind of purchases. Wherever we are seeing that we are getting good rates, we are going ahead and booking orders, and we are ensuring that we are able to serve all our customers. That's the key that we are looking at. And for us, keeping our customer base strong and ensuring servicing all the customers during this difficult time. I think that's the key what Rossari is focusing at, and I think this will pay off in the long run. And the customers are also understanding this philosophy that we are working. So I think we'll have to take it, month on month, or probably currently it's week on week on how we strategize the plans. And if as Chari sir also indicated, we are really not sure how long this is going to last, but we expect at least for the next 2 quarters things to be very, very volatile. So if they improve, then well and good. It will only impact. And the way the oil prices now are moving up, the situation in Ukraine and all, we really don't know how some of the products or the inflationary trends are going to behave. So we'll take this call, slow and steady, how best we can serve. And I think we only hope that things improve now. At least from Q1, things should improve both on the supply side and on the pricing side. And once even the raw material prices come to their normal levels, I think we are very well poised to get back to our original margin levels and see substantial growth in the top line also.
So just trying to understand, is there room to basically put a lot of thought and try to improve on the pricing model for products? Trying to understand if cost plus pricing model is possible in your kind of industry, or is it going to be, you have to take a call on procurement that way?
Internally, we have discussed a lot of models. The way the situation is, I don't think any model is going to work presently, at least for the next couple of quarters. Cost plus model, definitely we have analyzed, but I don't think it's going to work because we don't even know what the prices are going to be tomorrow, as I said. So if in case the prices fall down, the cost plus model is going to hit on our faces. So we are currently, as I said, taking it one at a time, doing a lot of short-term buys and short-term calls. Sometimes we are gaining in that, and sometimes we are losing also. But then that's how this business currently we are looking at. So hopefully, as I said earlier, if things improve, I think Rossari is completely poised to get back to and probably exceed the levels at which it was performing last year.
By coming back, you mean margins of upwards of 15% in terms of EBITDA margins?
Yes.
Okay. One more thing, if I could, can you just segregate the top line growth? What kind of price-related growth is there in that? Because it's difficult to understand given there are acquisitions, and so trying to understand the like-to-like growth of all the acquired plus your standalone entity generally.
I think there is a mix of both volume as well as value pricing growth. But yes, on a quarter basis, our volumes are lower. But on a YOY basis, I think the volumes are slightly higher. But yes, the major growth is coming from the pricing.
Okay. Thank you.
Thank you. Before we take the next question, a reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Anshul Vardia from Edelweiss Wealth Research. Please go ahead.
Thank you, sir. Thank you for taking this opportunity, sir. I have just a couple of questions. First one, as asked by our earlier participants, that one of our competitor in the textile specialty chemical is growing. So I just want to understand what is our right to win. I remember as per our earlier discussions that we were talking about the antiviral and advanced anti-wrinkle technology. So does that business have any moat as compared to other players in the market?
So the antiviral and the antimicrobial business is also dependent on the pull from the market. It's generally not a push technology. The push came only during the COVID time, and for textiles, it is basically pull market. So if a brand indicates that they want an antimicrobial finish, only then our processors we'll ask for the product. Otherwise, this product is not asked. So this is a kind of hand holding or handshaking with larger brands like Marks and Spencer's or JCPenney, people like that, and especially in the towel industry. And even within that industry, hardly 5% of the total volume goes into antimicrobial finish. So the antiviral and antimicrobial products that have gone in is basically in hand wash as well as in surface disinfection, basically.
Okay. And so on the other expenses, these have stably increased in this quarter. So I assume that is largely the fuel cost, or how it is trending into the 4Q. And could you provide some color on the EBITDA per ton? Like, I have tried to get the volume sense, but it was not very evident. So can you talk something on the EBITDA per ton trend as compared to the last quarter? Thank you.
Yeah, you are right. Other expenses have slightly gone up. I don't think there is any major increase, but yes, it's gone up because of the freight and transport costs going up, and slightly also on a YOY basis because of better utilization. Our utility costs are higher than what it was last year. What was your second question? You don't track. We don't track. Okay, it was EBITDA per ton. And we really don't track or talk about our EBITDA per ton numbers. So we generally go by our absolute EBITDA and EBITDA percentages. We would like to keep it that way, at least for the current period.
Okay, thanks. I appreciate your time. Thank you, sir.
Thank you. The next question is from the line of Pawas Petia from Enam AMC. Please go ahead.
Okay, thanks for the opportunity. So when you earlier stated that 2,500 crores is a potential sales from the current capacity, I'm also looking at what kind of margins you can generate out of these sales.
See, as we've already talked about this, Paul, that currently to give any guidance on margins is going to be very difficult for us. And as I said earlier, if the macroeconomic situation stabilizes, raw material prices stabilize at least. Even if they don't fall dramatically, they need to stabilize. That's what is actually hitting us. But if they stabilize, then I think on a consolidated basis, top line of 2,000, 2,500 is the target we are looking at.
Just when we look at your guidance of this 2,000, 2,500 crores, there's a lot of raw material inflation or product price inflation which is built in. So it's very difficult to gauge the, profitability trajectory. So you might have some internal numbers about EBITDA per kg which could be steady. So on that basis, any range for EBITDA which you can achieve once the steady state is achieved. And the second part is this 2,000, 2,500 crore, by how much time you think you will be able to achieve?
No, so EBITDA percentage, I said that once things get back to normal, we'll be back to our normal 15-16% of EBITDA. And currently we don't see that happening, at least for the next 2 quarters. So probably once things stabilize, then we should be back to our 15, 16, maybe even higher. We are internally already started working on a lot of new products, new formulations. Even the current formulations, we are also trying to rework on them so that, to achieve lower cost of production. So probably margins improvement will be seen on that front also. So I think on a steady state affair, things normalizing, we should hit back to our 15-16% of EBITDA margins. That's the guidance we can give as of now.
So Mr. Powell, what is the strength? One of the strengths of Rossari is basically formulation, the expertise that we have in formulation, and therefore our R&D is working feverishly in the last couple of quarters to use alternate raw materials and reformulate our products so that the margins improve. For example, we launched a product recently called Dr. Nanoxa. This product is for surface disinfection, and it keeps the surface disinfected for about are protected for about 30 days. So that's the test report that we have with us. And these are big example. This is a very big example. Other than that, what we are doing is we are trying to put in a small amount of capex, the maintenance capex. With the help of the maintenance capex, we want to produce granules for certain offerings in the market with our enzymes and with the animal health and nutrition products. We are also looking at tablet coating in pharma with our acrylic-based chemistries. So yes, in the background we are working feverishly. A is to reformulate and improve our margins, which we've been able to do in this quarter, and I think the products will roll out, have already been rolled out in this quarter. So you will be able to see some improvement in the margins, but all depends on the pricing. Basically everything depends on the pricing, as Mr. Ketan has indicated, that we are not taking any position in the market. So therefore, all purchasing is spot purchasing, and sometimes we are able to participate in a particular business, and sometimes we are not able to participate because of this strategy that we have adopted for the time being.
So Pawalji, here to add, on a consolidated level, we have done 47 crores in this quarter. So you will always see consolidated levels, and this is the highest ever EBITDA in Rossari history. Standalone may, have seen, to take care of the customers, some margin pressure, but as a company, we have earned very good EBITDA of 47 crores in absolute terms. And if you see, at just 47 crores for this quarter, and if there is a slight improvement, as Ketan sir said, we are looking at, a 250 crore kind of EBITDA for the next year, if the things stabilize or more. So for us, the outlook, even with a dip in the margins in standalone, but the good, strong growth performance, we have been able to retain customers. We have been able to add new customers. We are adding new products. So we see a very good, healthy next financial year.
Sure, thanks. And just the last part of the question is time frame for this target of full utilization of capacities.
Can you repeat, Pawalji, the question?
You were talking about 2,500 crores is the potential sales you can generate based on current capacity. So how fast you can...
On a consolidated basis, we should hit 2,000 crores in FY23. That's what our internal target is.
Okay. Thanks. That's all from my side.
Thank you. The next question is from the line of Dhruv Muchal from HDFC AMC. Please go ahead.
Yes, sir. Thank you so much. So the first question is just to understand the business a bit better. Now, let us assume that in a scenario that the raw material prices remain at the current level and stabilize at the current level, which is approximately 40-50% above what you were probably doing last year, which effectively gets realized in our revenues. So how does the business work? I mean, at the higher realization, which includes the benefit of inflation, do you still get to keep the margins at the same level? Say, for example, if you were doing 15% last year, because of the RM inflation, your realization has increased and your revenues have increased. Do you get to keep 15%, or the margins will become low, which is numerically seems obvious, but on per kg basis, you still earn the same amount? So, for example, if 100 has moved to 150 and 15% was your margin, will your per kg improve from 15 rupees to, say, 21, 22 rupees, or the percentage or the per kg EBITDA will remain the same? I mean, I understand this will differ from product to product, but from a holistic basis, how does it happen? How does it flow for a business?
Dhruji, we have gained a lot of goodwill in the last 24 hours being ethical and a supplier which works like a partner. So as you said, agar 100 rupees mein agar we have 15% margin and the inflation makes it 150, we cannot increase it to 22.5. It becomes unfair to the customer. So we are, partnering with the customer and we are trying to take it between 15 to 22.5 wherever it works together well with the customer, taking a partner-like approach. The second problem is not only margins. We have done, a deal for a product, and because we are, buying week to weak. Suddenly the raw material prices shoot up in the market, and then even if we have taken 15% as margin instead of 15 rupees as a number or a 22.5 as a number, the calculations are not fitting it, because raw material position में ना is like speculation. पहला लगता था कि 2-3 महीने का आगे का speculation है, but अभी तो weekly speculation है. As I explained, acrylic acid 2000 to 2700 in the space of 15-20 days. So we have a product called butyl acrylate monomer. 10 दिन पहले 135 रुपीज था, आज 200-200 रुपए की बात कर रहे हैं 10 days में. So these are very volatile times. Consequently, for example, acetic acid आप लोगे, it was 80 rupees a couple of months ago, or 90 rupees. It has come down to 60-61 rupees now. So how do you plan? So these are very volatile, uncertain, unprecedented times, and for us, as we have told in the last call also, we are trying to preserve the amount of money we earn on a consolidated basis. So 4750 crore rupees on a quarter is something we are very, very happy if we have been able to achieve in this unprecedented times. The second part also is our working capital, Dhruji. We have ensured that our working capital is maintained in terms of stocks, debtors and creditors. We let go of the business अगर पैसा नहीं आता है, and this has been our hallmark in the last 24 hours. We have a zero debt business. We are zero debt company in terms that we do not have even CC and term loan in spite of all these acquisitions and all this growth. Rossari के पास ₹1 भी CC and term loan नहीं है. So we are on a financially sound position, and as soon as we stabilize, it will look like a very good take-off stage for us.
Perfect, sir. No, sir, we completely understand the RM situation. What I was trying to suggest was, because our business seems to be a mix of margin basis and per kg basis, so it would be very easier for us to, understand the business also if you start sharing the per kg number. As one of your peers in the, not exactly a peer, but one of the chemical players in the industry shares volume numbers, so it becomes easier to, so the percentage number is extremely volatile, but the per kg number is what is consistent and, moves in broadly in line, because that is how the business works. So it would be probably, if you can think of sharing the per kg number, that would help us better analyze the numbers.
On an active basis, we have more than 1,500 products being produced on a monthly basis. If you see our range, it will be 3,000 products. So and there are different chemistries, different end user industries. So to give a guidance on a per kilo or a per ton basis is impossible for us.
Got it. Perfect, sir. No worries. So the second, a few big bookkeeping ones. I see the EBITDA is about, the depreciation is about 17-18 crores. Is this the normal run rate going ahead, or was there some abnormal here?
You are talking about standalone or?
The console numbers.
That console number includes that, as Marcy said, it includes the amortization on account of consolidation, PP.
Yeah. It's basically it's on account of consolidation of our. We have done the fair valuation of our consolidated companies, na? So that we have accounted for tangible and intangible assets fair valuation. So on that depreciation is increased.
Got it.
And it will be there. No, it will be there. The run rate will be the same as we have seen in the current quarter.
ध्रुव जी, हमारे लिए ना चाइनीज लोग हमारे सप्लायर एनिमी है, और हमारे मानसी जी और केतन जी हमारे एनिमी है पूरा. ये लोग अकाउंटिंग में मेरा पूरा प्रॉफिट ले लेते हैं. अभी इस टाइम पे हमारा कुछ ऑपरेशनल इनकम था 5 करोड़ का, वो हमने कस्टमर से रिकॉर्ड किया, तो उन्होंने वो अदर इनकम में डाल दिया. फिर ये डेप्रिसिएशन डाल दिया और कुछ इंटरेस्ट कॉस्ट डाल दिया. ये लोग अकाउंटिंग में क्या करते हैं हम लोग को समझता नहीं, बट हमारा मार्जिन कम दिखता है और आपको लगता है कि हम लोग पैसा नहीं कमा रहे.
No, sir. That is why the idea was to understand what is the cash profit. That is why. So the second thing is just one quick one again. I see the interest cost was also increased to 3 or 4 crores. I see no debt largely. So what's driving this interest cost?
The interest cost, because in our acquired companies there is a deferred consideration. So we have to do the NPV, do the accounting of NPV of the future consideration, which is 35% for Unitop and 24% for TriStar. And on that we have to account for interest liability.
Got it. So instead of minority, this is effectively coming here,
Yes.
but as part of the loan repayment. And this will continue for the next 2 years at least. FY22 and
Yeah, till the time the entire
until the time the
consideration
payment amount is paid. Got it.
ध्रुव साहब आप बोलो ना, इन लोग को नहीं करना चाहिए अपने को करके.
तो नहीं सर, वो माइनॉरिटी में आ जाता, नहीं तो एक ही बात होती है. Great sir. Thank you so much sir. Thanks for your time. Thanks.
Thank you. The next question is from the line of Siddharth Purohit from InvestQ Invest Advisors. Please go ahead.
Yeah. Hi, sir. So just one clarification, as you said, you still have a sizable capacity left to be utilized. So, just wanted to understand that, how is the offtake arrangement with the clients is placed for the next couple of years? Because you said you don't get into too many long-term contracts, but are they also getting into some sort of capex mode, or you have some sort of assurance at least that, you'll be in a position to utilize the plant, or you're looking for even adding new clients? Because in the opening remarks you said thinking of increasing customer wallet share. So how that utilization level will go up? That's what I was trying to figure out.
So Siddharthji, thank you for that question. Like we said that we have close to 50% capacity at our Dahej plant, and in the past we have also maintained that Rossari does a lot of seeding in our business, and like in the last few quarters, more than 2-3 quarters, we have been seeding various industries. The industries like water treatment, industries like paint, paper, ceramic, and cement. So these are the 4 or 5 industries where we've been seeding, and there are some new ideas which have come up in the last 2 years. One of them is polyester resin. The other is, because of the acquisition of Romack, is silicone polymers for textile as well as for personal care. So, and the plant is very well geared up for all these product lines. And therefore, I think there is not going to be a very big capex requirement. The capex requirement, as we have indicated, will be in the region of 4 to 5 crores, which is the maintenance capex at the present moment. The only capex that we may require as we look going forward is for granulation and a premix plant. So that also is a very, very, very small capex. So therefore, the plant capacities are there in place, and the seeding has already been done. Once the industry really opens up and the product prices, the raw material prices stabilize, then we see that we will be able to utilize this capacity and go all out for these products that we have already introduced. The only other big spend that we've already committed to is SAP. So we are going in for SAP for the entire organization, that is for all the 5 entities that are under the Rossari roof today. And that would be a sizable cost, maybe between 3.5 to 5 crores. So apart from that, we don't see any big capex which is required to fulfill all the technologies that we've already introduced in the marketplace. We have seeded the market, it has been tested. We are just waiting to go all out for sales with these products. Most of them are polymers, and these polymers are based on acrylic chemistry, acrylates, as well as polyester and silicones. All these 4-5 raw materials are highly volatile today, and these can give us big volumes. Polyester resins can give us big volumes. The acrylate chemistry can give us very big volumes. The acrylic chemistry gives big volumes. We've also introduced a certain product which is a solvent which is used in viscose manufacturing, which will go to large companies in big quantities. So that is also something that is planned for the future. But the plant at Dahej is well equipped for manufacturing all these products. It's only a matter of time once the raw material position stabilizes and the people are able to move to customers face to face. I believe that we will be able to quickly utilize this capacity. We had given an indication that we utilize the capacity in 3 to 4 years. In 1 year, we have reached 50%. And I think if the polymer monomer market stabilizes, we should be able to do that capacity within 3 to 4 years very, very easily.
Okay. Okay, thanks.
Thank you. The next question is from the line of Ayush Agarwal from Mithil Investment. Please go ahead. Mr. Ayush Agarwal, your line is in talk mode. Please proceed with your question.
So I hope I am audible.
Yes, sir. Please proceed.
First question is, picking up on our previous participant's question on our listed player, which is talking about, I'm not specifically talking about the player itself, but they are talking about huge growth in the technical segment where they are taking away market share from European MNC. So, what is our view on this and what are we proactively doing to grow aggressively in this segment?
Ayush, if you see our sales, it has grown phenomenally. 700 crore last year, we are talking about 1,500 crore sale, double sale. So we have grown across customers, across segments, and we do not have any customer where we lost share compared to last year. We are sure about our numbers that we have gained share across customers in all our customers and segments.
So what kind of growth are we seeing in this textile segment, and what are our steps that we are taking to gain away more market share, given that we are leaders and pioneers in this industry?
So see, as I said, we are now, crossing more than 100 crores per quarter in textile, whereas last year, I think we were in the range of about 250 crores. So we are seeing a 50% or more growth in the textile business, and the textile business looks strong even with exports, from other countries. Bangladesh is our topmost export market. So even in the domestic and the export market, we are strong with all our customers. And the top line growth itself proves, we have done fantastically well across different segments.
Okay. And so if you can share some, insights on, the kind of customization. I have read through your previous transcripts and your RHP as well. So we do a lot of customization for our customers in the textile segment. So when we say customization and, green products, so what would be the kind of revenue that comes from these customization and green products in the textile segment?
Mr. Ayush, actually, there are no numbers that we have put to them. But as an internal target for Rossari, more than 10% of revenues every year we target to come from new products and new areas of operations. So if you look at the textile industry, I already explained to you what we have done in the last few quarters. So we have introduced polyester resin for sizing, which is a market which can go up to 500 to 1,000 tons if we go for export in these products. We have introduced two new green chemicals, green urea and green silicate, that has gone into the marketplace. We have introduced substitutes for chlorine bleaching. We have introduced an enzymatic substitute for bleach. We have introduced lycra protector. We have introduced water repellents. We have introduced C0 water repellent in the marketplace. We have introduced also some acrylic polymers in the textile industry for washing off. So if you look at the entire basket of products, like I said, in the silicone polymer industry, Rossari is the largest seller of block silicones. So we manufacture our own block silicones in-house, both at Romack as well as at Rossari Biotech. So we are the largest here. These products, they go into fabric which requires hydrophilicity, which requires water absorption. So like towels, underwear, undergarments, and things like that. So of course, Rossari is a leader in this market, and like Mr. Charya explained to me, we've already grown by 30-40% in this year. Top line has already grown from 260 crores to going to touch 40 crores or 400 crores this year. So why those questions are coming that you are not growing and your market share is being taken away is a little bit of question mark for you. So you should check your numbers also, sir.
Here, I would like to add, we would like to focus on our business rather than on our competitors' business.
So my question, and so there's no question about that. So I was just trying to understand the changing landscape and where this goes. That was and what is Rossari doing to gain, and obviously part of that.
So your voice has been cracking. Sorry to say, sir, your voice has been cracking. We couldn't hear this question clearly.
Is this better, sir?
Yes, now. Yes.
Yeah. So no, I wasn't saying that Rossari hasn't grown. My primary question was that, understanding the landscape of where this growth is coming from and what is Rossari doing to, capture more market share, which partly got answered when you said that, we are growing at 40%.
Yeah. And I forgot to mention that we've also entered the spin finish market now. So we've already entered the spin finish market with a range of secondary spin finishes. That also is a large part of the marketplace where we were not present in. And we partnered with some overseas companies for the spin finish technology also on our range. And we've introduced also a lot of processes for economic dyeing in the textile. That is especially dyeing the blacks and the blues economically, which are almost 30% of the shade that goes into the marketplace. So that is also going to be a big chunk of our business in the future.
Right. And my last question is if it's possible for the management to bifurcate the margin between HPP and home and personal care and textile.
Sir, as we have been telling in the previous calls, our facilities are fungible and common, so it is very difficult for us to bifurcate cost and margins. So we have never done it in the past, and there are no plans to do in the future.
Right. No worries. Thank you for your answers, sir, and best of luck for the future.
Thank you, Abhishek.
Thank you. This is a final reminder. Anyone who wishes to ask a question may press star and 1 at this time. As there are no further questions, I now hand the conference over to the management for their closing comments.
I thank one and all of you for giving your valuable time to us. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarification or would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us all on this call. Bye-bye.
Thank you. Ladies and gentlemen, on behalf of Rossari Biotech Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.